Good morning. I'll call the Deferred Compensation Advisory Committee meeting to order. Today's Thursday, April 25th, and the time is 10:01 a.m. We'll start with a roll call.
Roll call, Jennifer Goodman.
Here.
Fonse Kyokum.
Present.
Jason Whelan.
Present.
Stephen Hopkins.
Present.
Sandy Regallo.
Present.
For the record, today we will show that Jeff Woolcamp, Kathy Herman, and Paul Canepa are not present.
Thank you. The next item on our agenda is the approval of the minutes of the quarterly meeting, which was held January 25th, 2024. I'll entertain a motion, or unless there's some questions about the minutes.
I move to approve minutes. Second.
All right, we have a motion and a second. All in favor, say aye.
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 Opposed? No? Okay. Carries unanimous. 5-0. Next on our agenda is public comment. Ms. Strange, do we have any public comment?
There is no public comment at this time.
Okay. Seeing no one in the room, we will move forward. Next on the agenda, informational item regarding the NAGDA annual conference. Wanted to ensure that all of our advisory committee members were aware that there will be a NAGDA conference in Phoenix, September 15th to 18th. If you are interested in attending, please let us know. I will send out to each of you some information regarding the agenda and information. So if there is interest, we would like to make sure we get you scheduled to attend. I do believe that I will be attending this year, and there may be others who have an interest as well. So
I'll be interested in attending.
all right, nothing further about the NAGDA conference, then we'll move on to our program status reports for the first quarter from Nationwide. And is John going to do the presentation remotely, or will you be?
I'll take care of it. This is Greg Sabin from Nationwide, Program Director. John is unfortunately not able to be on camera. He is stuck in traffic in Southern California. So I will take over our quarterly review. You should have in front of you a copy with the blue cover of our quarterly review, as well as quarterly numbers from the Charles Schwab self-directed brokerage account. Everyone should have both of those. Goal here is to go through some of the highlights of that report, touch briefly on the Schwab report. Brenda will give a quick quarterly update as far as field report goes. So if I could have you just turn to the first page after the cover page. Just wanted to point out a few things to take a look at. We did have in the fourth quarter, quite a lot of assets coming out, both in usual fourth quarter required minimum distributions, withdrawals from the plan, alongside of rollovers out. That came down quite a good deal for the first quarter. Still seeing more outflows than inflows, though, currently in the plan, so something to keep an eye on for 2024. I'm sure, Vince, you have a portion in your presentation as well to kind of go through those numbers as well. As we drill down on the 457, if we move ahead a few pages, we'll see that the majority of those withdrawals came from, this is on page 4, came out of the 457. About 10,700,000 and change came out of the 457. That's in rollovers and withdrawals, so terminated, retired employees, with a contribution number of over 7 million. Nice news, though, as again, Vincent from Hyas will go through a lot of performance numbers. We saw a gain in the market in the first quarter of nearly $30 million. So that is good news across the board. Overview page on page 5 kind of lays out the assets currently in the plan. The SDBA, or self-directed brokerage account balance, we'll talk about that a little bit later, but over $2 million now in assets. We have over 7,000 participants with a balance, and we saw just a small uptick in new enrollments for the first quarter of over 200 new enrollments, and Brenda will speak to that a little bit as well. Not nearly seeing as many transfers or rollovers in, less than 500,000 for the first quarter. On that page, you'll see 457,903 in rollovers in. Bit of a smaller number there, and but staying around $500,000 per quarter. So with $2 million in rollovers in, we'd like to see if we could bump that number up. But that is definitely an aspect of who's being hired, when they're being hired, in terms of what previous assets people have. If we wanted to skip down a little bit to page 8, wanted to take a quick look at contributions. Basically, where are people putting their money? How much money are they putting in? You can see that in the bottom right-hand corner, asset allocation funds, those are the target date funds. And by the majority of all new dollars are going to those target dates funds. So that's a sign of plan health. Folks are making smart decisions there, going into those target date funds if they'd rather not make individual investment decisions, as well as the fact that those are your default funds for new employees. So if they're just taking hey, I just want to sign up, I just want to put a few bucks in, I don't want to make any investment choices, that is the default, the target date funds. So that is working as it should.
Greg, can I ask a question
Please.
about the default? I know the target date funds, right, there's a varying dates that you can select. Does the default go to the most conservative, or?
The default for target date funds, let's say I was to enroll in a new plan, and I'm 47, right? I'm 47 years old, so it's based on your birth date. And it would go to the fund closest, roughly to my 65th birthday. Do I have that right, Brenda? At 65, yes. 65th birthday, so I would wind up with the 2040 fund. If I was a little bit older, a little bit younger, it just would put me in that. So the younger the employee, the more aggressive the fund, because it's going to be a further out fund. The longer term they have, the more aggressive they're going to be. On page 9, more details on those rollovers out and distributions. When we take a look at the number of distributions, the types of distributions, they were almost all down in the first quarter. Again, this is usual. We typically see more transfers out, more distributions in the fourth quarter, and then first quarter is going to be a drop-off from there. At the bottom of the screen, you'll see where a lot of those assets are going. They're going primarily to independent financial advisors through LPL, perhaps Charles Schwab, whether that's going to be an online brokerage or a financial advisor through Charles Schwab. Fidelity could be either an independent account, or it could be a new employer plan if that employee is moving to a new employer that has Fidelity as their 401k provider, perhaps, or 403b. We see that frequently with medical professionals as well as they go to any new folks. I think the big takeaways here are when people leave the plan, they are not leaving for fees, right? They know, hopefully they know, and Brenda definitely does a great job on letting people know the plan is very, very affordable, inexpensive, and efficient for their needs. They're leaving for products or advice, right? They want someone to give them direct investment advice. They want someone to manage their investments for them. They're looking for perhaps, and Brenda, I think you can speak to this, they're looking for structured income in retirement. A lot of people will leave and looking for something like an annuity or some type of product that can pay them something over time, especially Brenda just mentioned some of the older or more tenured medical professionals who had lower or no pensions as part of their benefits. So that's the kind of decision making we're seeing in the overall plan, in case there's any questions about that. Just one more thing to note, again, with inflation, with difficulties in people's finances, on page 15, take a look at loans. Seeing about new loans at about 40, 45 per quarter for a plan this size, given the current economic conditions. That's about what we're seeing on average right now. Those loans are, while not the greatest decision for people in their retirement savings, definitely a lifeline for some people that can allow them to make maybe stronger financial decisions down the road, hopefully, and continue to pay those back. But something to keep an eye on. But overall, with a current average loan balance, you'll see in the top right-hand corner of page 15, about $10,000 is the average loan. So that speaks to the needs that some folks have, whether that's fixing a home, buying a new car, fixing a car, things like that, that tend to be the most common reasons for people to make those withdrawals. One last page I want to focus on is page 16. Just talks about our engagement, and then I'll pass it over to Brenda for a few words. You see that a good number of participants are engaging with the plan. We feel that online engagement not only is good for retirement savings, it's good for retention, it is good for security. We see nearly 70% of folks signed up for e-delivery. We have 90% of accounts have beneficiaries on file. You see that that is just crushing the benchmark of 64% across the country. That's great news. We're seeing we have nearly 90% of participants' emails on file. We could definitely see a higher adoption of online accounts. We could see a few more online enrollments as part of our processes, but right now there's definitely some highlights to look at. On the bottom there, you take a look at My Interactive Retirement Planner. Only 30%, less than a third of folks are using that My Interactive Retirement Planner, which definitely helps them structure and feel more confident about a long-term retirement income plan. We are going to be updating that plan, and John will bring that before the committee to show a little example of that probably in the next quarter or two with some updates there. But it's definitely something that we work on as part of our online communication and education with everything that we push out. Also, the My Investment Planner, which is an advice tool for participants, something that you know that Nationwide is very, very behind our participants getting as much information as they can, especially free information, free advice. We partner with Wilshire, and they provide free advice to people on how to invest. We'd love to see more people taking advantage of this. We actually, part of Brenda's compensation is actually tied to how many people she's walking through this tool. So really, Nationwide wants to put our money where our mouth is, even on this benefit that is totally gratis. So we'll continue to look at that number as the months go by. I'll turn it over to Brenda unless there are any questions.
I do have a question, sir. Does Nationwide look at it as total county participants, or is there any way to look through a little bit deeper on the data and see which departments within the county are contributing to deferred comp versus not? So we might be able to target some agencies more. For example, culturally, one department might really emphasize this versus another, and then we'd know that. So I don't know if we have that data, or it'd be difficult to get.
It's a great question. We have seen similar requests and then similar campaigns from other counties, but it is not something that we know at Nationwide. That is information that is held here at the county in terms of what department someone is in, what bargaining unit they're in. That type of information does not get transmitted to us.
Great, thank you.
Yeah.
Just to piggyback off that question, what about in regards to a benchmark? Where are we at to our comparable counties? Do we have more members in the program, or do we not have more members in our program?
In terms of participation rate at this point, I'll have to get back to you. You know, when I'm looking at this report, that's not a number that pops out to me. For our next committee meeting, I'll definitely have a specific participation rate in terms of how many are eligible versus how many are participating at this current time. We'll partner with HR to get those numbers in there for you.
I'd like to see it in comparison to other counties. I mean,
sure.
Just to see, hey, we're doing a great job, and a lot of people are using the program versus, or are we not doing so well? So
right.
That's what I'm more
I'd say
interested
there's three big factors, two main ones that's popping right away that influence that participation rate. One is if the employer and individual employee participate in Social Security or not, right? So those that participate in Social Security usually have a lower participation rate in their savings plan. The other one is whether or not the employer, in this case the county, has any kind of match or incentive for employees. And those with matches usually have much higher participation rates, as would be obvious. Those with Social Security have much lower. So finding exact comparable counties, there's going to be a range. Let me just put that out there. Yeah. Any other questions?
This is John. If I could just make a quick comment, is that we're not sent the eligibles from the county. So if there's a way to get the number of eligible employees, then we could run a calculation for you manually.
Thanks, John. And here's Brenda.
I'm sorry, just one real quick question. Just The My Investment Planner, since is that something that's fairly new, since it's less than 1%, and there's 31% of the people that have the retirement goal? Is that a new thing, or that's been around for a while and it's just not?
It's been around for a few years, definitely not as long as the My Interactive Retirement Planner, and that My Interactive Retirement Planner is on the front page. When you log into your account, it's the first thing you see. My Investment Planner is a tool that you see when you go to look at your investments or change your investments. So it does require that next step that people don't always engage in.
All right. Brenda DeVecchio with Nationwide. Glad to be here. So the first thing I wanted to just touch on is the partnership that we have with you in regard to the quarterly meetings that we offer. Historically, those have been a little better attended. The first class that we offered about enrolling, there didn't seem to be much interest, but as we kind of went through from class to class, the interest built, and I would say most of the people were very interested in the learning about pre-retirement and then also learning about Social Security. So we tended to have most of our participation in that space. So I would say lower than average numbers, around 50, versus we tend to get close to 100. But still some engagement, which we always appreciate. As far as my visits out in the field, they're going really well. I'm working to reach out to more and more agencies and departments and build up my calendar for this quarter. And I'm going to be visiting the sheriff's office this afternoon so I can get cleared by them to start making visits there as well. So very excited about what is coming up in terms of what we're doing. Happy to see the enrollment numbers. Your agency does a really great job bringing together all the new employees, doing the new employee orientation. It's so great to be a part of that. You guys provide me with the list. So not only do they hear about it for a few minutes during the NEO, but I also have the opportunity to follow up with them. I send out our easy enrollment form via DocuSign, and I see a lot of engagement with that. So it's something that kind of just reminds them for about the 60-day window that it's available to them. So, while they're kind of getting a little more comfortable with their jobs, it's kind of in the background as a reminder. I send reminders about every 15 days. And then, of course, I always tell people they can enroll at any time, but here's the easy enrollment form just to make it a little more accessible. So I think that's part of what's driving the numbers for people who are new, just sort of engaging with the plan and getting that started. And that could be part of the disconnect when they're filling out the form. They're not doing the online enrollment, so they have to take the next step when they see the welcome letter to actually do the online enrollment. So that tends to be more of a second step where they're engaging with me or our home office to help them get online to make things like contribution changes. And of course, when they meet with me, we go through the tools, and every opportunity that I get, we look at the investment options. I know, Chandel, you and I have done that together, so it's a great tool where we can learn about how people feel about investing, sort of how does that match up with what they're doing right now, and then talk about whether or not they want to make changes. So that's all seems to be going pretty well. There were questions about the rollovers out, and I did mention to Greg a couple of our long-term doctors that I had worked with for years and years and years, recently retired, and they did choose to take their money elsewhere. Knowing the history of the plan, knowing that the doctors didn't always have the pension option, they're looking for ways to parlay all that money they've saved into some sort of guaranteed income. So it's sad to see them go. They're near and dear to my hearts after all these years of working together, but I did help them with those rollovers out. Even though I did try to retain and let them know they could keep money here if they wanted to, they did choose to go elsewhere. What did you want to address the Secure 2.0?
I'll mention that after we go through the Schwab.
Okay, and you're going to do that?
Yeah.
Okay, I'm going to hand it back over to Greg to go through the Schwab report.
If you hand me that. Really, this is just 60 seconds. The Schwab PCRA Personal Choice Retirement Account on the first page. Feel free to look into this a little bit more deeply, but currently there are only 13 accounts total with PCRA, which is somewhat normal. We do see a fairly light uptake rate for this type of service. This allows individuals to invest in stocks, bonds, mutual funds, other investments, and however, there are some fairly high balances. The average balance is $170,000, so it is being used exactly as we expected it to be. People investing in niche investments like Bitcoin ETFs, but also more than half the money is in fixed income, which is also what we felt was going to be very popular currently with high rates, CDs, other money market funds, things like that within the program. So again, the fund, PCRA, Personal Choice Retirement Account, is being used really as expected. I know we have a lot to talk about on the funds, so I won't take up any more time other than to say for next quarter, we're hoping to do a review of some of the new Secure 2.0 provisions, either whether they need voting or non-voting issues around updates for retired safety officers and such. So something to expect for our next meeting.
Thank you. Next on the agenda is the first quarter performance report by Vincent from HIAS.
Thank you very much. For those who I met before, my name is Vincent Galindo. For those new in the room, we are the investment consulting firm to the plan. Similar to Nationwide, we're an outside vendor. The important distinction is that we adopt fiduciary status, meaning that despite the fact that the county is technically our client, the group of people that we're advocating for are the participants, whether they're employed or not. And so every recommendation that we make has to benefit not the county, but those participants. And so, again, we take that role very seriously, similar to the staff here at the county. We got a lot on the agenda, so let me go through the performance report. And we have 3 bound reports that look very similar. The first one that I'm going to go through is the March 31st performance report. And it is a very interesting time in the marketplace. Prior to today, a lot of the good news was actually somewhat bad news for those looking for interest rate reductions. I'm looking, maybe some don't have the report. There's one, yeah, March 31st.
So there should be one that has actually like a little bit of a window, and it says March 31st performance report.
We're good? Okay. Thank you. I petitioned to get different color reports, but somebody likes the white, and so we're just going to have to explain it. Okay, so flip ahead. I talked about some of the good news turning into bad news. At the beginning of this year, there were 3, 5, some firms predicted 6 interest rate decreases this year. Given the good news, the jobs numbers continue to surprise on the upside. That bleeds into a higher inflationary number. Right now, there's probably 1 interest rate decrease price in the market, and that's going to be in September. It's not lost on the market experts that it's also an election year. I don't know if you saw the news, but there is a presidential election year. The odds are very, very favorable, despite the fact that the Federal Reserve is apolitical and they have the dual mandate, which has nothing to do with the election. There is a strong likelihood that in this election year that we are going to see an interest rate decrease, which is generally good for the market overall. And I'll talk about that here in a second. Go ahead and flip ahead into the report, past the text-heavy narrative onto page 5. I do want to highlight some of the things that we're seeing in the economy and then talk about what we're seeing in the markets. So if you take a look at page 5 on the upper left, that's the gross domestic product, or GDP. Most economists would say this is a good measure of our economic activity. The solid line is corresponding to the left-hand vertical legend, and that's the dollar value of all the goods and services produced in the United States in any given year. The nice thing is it's continuing to go up. The lightly dotted line is the year-over-year change. And a lot of experts consider a 2 to 3% GDP growth rate as this Goldilocks economy, because it's not too hot, not too cold, just right. In the second half of last year, we saw a GDP print of 4.9% in the third quarter, 3.4% in the fourth quarter. That's relatively good news because it is a frothy economy. The challenge is this morning, the first quarter GDP number was announced. The expectation was 2.4%. It came in at 1.6%. And there was a sell-off on the market this morning. And so maybe we're seeing some of the retrenchment in the economy with a 1.5% GDP versus that 2.5% expectation. But the good news is, and now I'm pivoting to the right-hand chart on the top, the unemployment rate. I talked about the strong jobs numbers that continue to do very, very well. A measure of full employment is an unemployment rate of 5%. We have been below 4% for the last 2 years. The latest read nationally is 3.8%, so relatively good. Here in the county, it's a little bit higher at 7.6%, but the nice thing is the American consumer, given strong wages and strong jobs numbers, continue to prop up the economy, and we have continued to spend, and we're very, very resilient. And that ticks down into the relatively bad news. The Consumer Price Index on the bottom left, or CPI, is but one measure of the inflationary number. The Federal Reserve has a 2% target. Right now, it's at 3.2%. And so they think that's close enough to the 2% that there's no more interest rate hikes. But as I said, we went from 3 to 6 interest rate decreases to now maybe one, very likely just one this year. But we'll see. It's still in April. We have a number of months left in the year, but it's interesting nonetheless. The challenge is, as I go into the bond market, with those interest rate decreases off the table generally, we did see a spike in interest rates on the longer end of the yield curve. And bond math says as interest rates go up, the value of existing bonds go down, and that's exactly what we saw. So if you take a look at the next page, page 6, upper left, second line down, that's the Bloomberg US aggregate. Last year, it did very, very well, but take a look at for the quarter. Most bond investors don't like to see losses, but that's exactly what happened as we saw that 10-year Treasury spike during the quarter and since March 31st. You can see for the quarter negative 0.78%. Year to date, as of this week, negative 2.9%. So some weakness in the bond market. And then about a third, maybe half of the way down, you'll see that Bloomberg US TIPS. That stands for Treasury Inflation Protected Security. You can see flat to negative for the quarter as of this week. Year to date, negative 1.5. And then there is a future agenda item talking about the high yield. About 3/4 of the way down, you'll see the Bloomberg US High Yield Index. That's positive at 1.5% for the quarter, but a little bit of retrenchment this week, 0.5% to the positive. So about 1.5% give back on the high yield or junk bond index. But the good news continues on the stock market. The next page, page 7, upper right, you can see the S&P 500. After a nice 2023, that trend continues. And again, it's not lost on us and it's not coincidental. It is that election year, and historically the market is up 7 to 10% in a presidential election year. The S&P 500 just for the first 3 months up almost 11%. There has been some pullback with the sell-off with the higher interest rates. Year to date, the S&P 500 is 6.8% as of this week. So again, a little bit of pullback on the U.S. stock market. But don't forget, on page 8, there are about 45 countries outside the U.S. with an investable stock market. So Canada, Mexico, China, Taiwan. The chart on the upper left, first line, is the ACWI, or All Country World Index, minus United States. The ACWI for the quarter up 4.7%. Year to date, 2.1% to the positive as of this week. So another pullback on the international markets as well. So this is where sometimes I get questions or comments. Okay. Go ahead and flip ahead to the next section. This is a somewhat executive summary or high-level overview of the plans. On the pie chart, you can see across the 457 and the 401A, about a third of the assets are in large company stock funds, about 30% or more in the conservative fixed income. And then that yellow portion is relatively healthy. That's that asset allocation, or those target date models that are broadly diversified within one option. There is a little bit of discomfort from our firm with some of the managers. You'll see on the middle left the plan notes for the fund. We are prepared to present an intermediate term bond fund search, a high yield bond fund search, and an international index fund for your review for possible replacement of some of the funds currently on the menu, as well as an addition on that international side. We also, on the agenda, have the investment policy statement. The good news is, despite the fact that we are recommending replacing two of the funds, now I'm on the bottom third, MetWest, Total Return, and TIAA-CREF High Yield, those funds are candidates for replacement. T. Rowe Price is a fund that was placed on watch in the first part of 23. Our recommendation is to retain that on watch. And then I'll skip towards the bottom, that Invesco Real Estate, another fund that was placed on watch last year. Our recommendation is to retain that on watch, but I'll tick up one to that MFS Midcap Growth. About a year and a half ago, one of the three portfolio managers by the name of Paul Gordon announced a leave of absence. That turned into an extended leave of absence, and then that turned into his retirement. It gave us discomfort because he played a significant part in the management of this fund, but there's two other remaining portfolio managers, and we said, given the strength of the remaining team, despite his departure, we're going to keep the fund in the plan but place it on watch. After a year, the dust has since settled, and we're completely comfortable with the remaining team, and so that's why our recommendation is to take it off watch, but the catalyst to put it on watch about a year ago to begin with. So relatively good news there. If you flip into the next section, page 11, a nice return for the quarter. You can see the navy blue columns on the bottom of page 11. For the quarter, the plan returned 6% on a weighted investment basis. So stripping out any cash flows, just how the funds did, about 6% for the quarter, 16.5% for the year. Now it's a little bit more muted as the longer terms get annualized, especially after 2022. Over 3 years, the plan was up about 5.25% every year, and then over 5 years, about 8% annualized. And so from a performance standpoint, relatively good there. If you flip to page 14, I don't want to echo some of the relatively negative news, but I just want to call it out to hopefully we can come up with a strategy or at least keep talking about it so it's top of mind. Towards the middle of page 14, there's a cash flow summary. Third line down is where we take all the money going into the plan, all the money leaving, and you can see for the second quarter, about $500,000 or $481,000 more left the plan than went in. About double that in the third quarter, about $932,000 more left the plan than went in. And then we do typically see a spike in the fourth quarter, but this is somewhat of an anomaly. You can see over $10 million more left the plan than went in. The good news is in the first quarter, it's since settled back down, but still over $3.5 million. And again, it just goes back to what Brenda was saying, just talking to participants about either bringing more money in or trying to stem the tide of those people leaving. The good news is, though, is they have the option. And so a lot of people do decide to stay, but some people decide to leave, but that is their prerogative. And so what we have to do is try and echo the value of retaining assets in the plan. And then on page 16, you can see the relative growth over time. There was that pullback with the market disconnect in 2022. Both the stock and the bond market sold off rather dramatically, and so there was that huge decrease. The nice thing is the plan has since come back to over the high water mark in 2021. And so nice chart there. Moving into the 401 program, you can see on page 18, next section, a little bit higher returns. This is obviously a different demographic at the participant level, different asset allocation mix. You can see for the quarter up almost 8% at 7.7%. For the year, over 22%. And then annualized over 3 years at just under 6%. And annualized over 5 years, just over 9%. Different cash flow characteristics. In fact, you can see on page 21, short of 1 quarter, back to my point with the RMDs typically spiking the distributions in the last part of the calendar year, we did see 3 quarters where the 401 plan was cash flow positive. And then on page 23, you can see the growth rate of that plan, despite the fact of the pullback in 2022. 2024 did see that eclipse of the high water mark in 2021, and then even more in 2023. So nice growth rate in this particular plan. And then on the next section, page 25, this goes back to my point about some of the funds that are on watch. And I'll just take a few seconds to explain what watch means, because sometimes we talk about it as a consulting firm, but you as a committee member may not really know. So essentially, the fiduciary process and the best practice in California is about the process. It sounds counterintuitive, but it's not about the outcome. Even though we're consistently want the most appropriate plans, if we were ever challenged by the plaintiff's bar or the IRS or any other organization, they were going to ask about not the outcome, but about the process. And so part of the well-documented prudent process is a watch process. And so if a participant ever asked you as a committee, look, I noticed one of the funds was underperforming, you can say, yep, we have that fund on watch. It's part of our due diligence process. The other part of it too is it goes back to the fiduciary best practice, but it's also a step for, not always, but replacing a fund. Generally, terminating a fund is almost like terminating an employee. We never do it on the first time or the first transgression. We build a case around it, and it's similar. We try and find the most appropriate managers, but sometimes there's a change in the personnel, sometimes there's a change in the process, and so just because a fund goes on watch doesn't necessarily mean we're going to fire it, but generally speaking, it's a good first step if there is ever a chance of termination. And so what we do is we have metrics in the investment policy statement that says if you violate the metrics, we're going to place you on watch. At this point, it's merely a process-based system, and you can see the two right-hand columns, there's a number of blue dots. That's where the characteristics meet or exceed the metrics in the investment policy statement. We screen qualitative factors, so growth in assets, shrinkage of assets, high expense ratio, maybe there's an SEC investigation, maybe there's a manager who took an extended leave of absence and then retired. All these fall under the qualitative bucket. The next column is a quantitative. This is really where there's a performance issue. And generally over a full market cycle, which is 5 years, we expect a fund that's actively managed to beat the index as well as beat the peer group above median. And so I'll take a large cap value manager. Morningstar takes all, let's say 1,200 large cap value managers and sorts the performance over different time periods. The expectation over 5 years is that your actively managed funds are above median. If not, and it doesn't beat the benchmark, it's going to show red on that quantitative screen. Does that all make sense? Okay, so our job as the investment consultant is to not just report this every quarter, which we do, but on a much more regular basis, talk to our managers, talk to the analysts, talk to the people behind the process, making sure that on a regular basis, more frequently than quarter, is that the portfolio and the process is still sound. And if not, that's where we come to you and say, it's time to move on. And that's what we're doing with the intermediate term bond manager, Met West, or Metropolitan West, as well as the TIA-CREF High Yield Fund. And so that's further on in the agenda. But back to my point, going down, MFS mid-cap growth, no longer showing that red dot, and our recommendation is to remove it from watch status. Okay? Let's move on to the next section and talk about the fee structure. So the fee structure is outlined on page 34. The nice thing about the calendar year columns is that there is a decrease over the years. And so that grayed out portion of the column is the investment cost. This is what participants pay the investment managers to participate in each and individual investment options. The navy blue portion is what the committee retains for plan-related expenses. So it could be for consultant, it could be for legal, it could be for audit, it could be for training at the NAGDA conference. This is the portion that they collect to pay for expenses that are plan related. This is not county money. The IRS, for good or ill, says only one thing: it has to benefit the participants. And so if you as a committee can reasonably say this cost benefits the participants, that is a legitimate plan related expense. And then last but not least, the orange portion is the nationwide revenue requirement of 2.25 basis points. And so you can see generally all those fees have decreased over time. So good news there. This is the 457. You can see on the next section, page 38, the 401, similar trend, decreasing over the last few years. Relatively good news. So questions on that report?
Just really quickly, Vincent, in regards to the admin fee, is there a balance in there? And I don't think, is it shown in the
Yeah,
PowerPoint here?
do you know who, does Nationwide maintain the administrative allowance account, or does the county? Yeah.
I believe that the county maintains that as a administrative fees, and then we would be using that for supporting not only the training costs, but the salaries of staff. So I can verify that, but I believe that the county does retain that as a separate.
Be interesting to just know the balance.
Yeah.
If it's $10 million that we need to spend down, or is it 100,000 or something?
Or 2,000. I think it's, yeah.
It's
We
definitely
can-
not 10 million, I can say that. But I believe that's even part of what we present as part of the budget, is what that fund balance is. So we definitely can, at our next quarterly, we can present that to the committee, but then I'll make sure, Fonse, you have that information as part of the budget process.
So Chair, from a process standpoint, the removing MFS from watch status, admittedly, I forgot, is that an automatic, or does it require a discussion vote?
I think that's going to require a motion and a vote from the committee. All right, so I think if I'm looking at the agenda correctly, you're talking about the remove from on-watch status, the MFS Mid-Cap Growth Fund.
Correct.
Do I have a motion from the committee to accept Hyas's recommendation to remove from watch?
This is Fonse. I'll make a recommendation to remove from watch.
I'll second the motion.
Okay, we have a motion, a second. All in favor, say aye.
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 Opposed, no. Motion carries 5-0. Thank you. Is there any other action we need to take from, as far as the watch funds, or was that the only action we
That was
needed
it.
today?
Yeah.
Okay, thank you. All right, then we will move on to the second page of the agenda for the committee members. The next agenda item, also Vincent from Hyas, the current fund lineup overview and fee and review analysis.
Did the fund review and the fee analysis, and so now I'm moving into, I don't know if they're numbered.
Okay.
The intermediate term bond and high yield bond search.
Okay, sorry about that.
No, could have been clearer.
All right, so we'll go on to the intermediate term bond fund, and I think we have a separate report on that.
Another white covered, actually two white covered reports. One is intermediate term bond, and the other is high yield bond searches. And before I get into this and the rationale and the recommendation and data points for days, I don't want to sound patronizing, but I also don't want to talk over your head. Should I spend a few seconds or a few minutes talking about what a bond fund is, as well as a high yield bond fund, so that we're all on the same page, or is that understood?
I think it would be beneficial for a quick overview.
Okay. I think a lot of people, and Nationwide talked about it with their self-directed brokerage analysis. I think a lot of people are fascinated with the stock market and individual securities and funds that invest in the stock market. Because it's generally exciting and they're generally household names that everyone recognizes, typically on the tech side or the energy or the automotive, like Tesla. But then there's another asset class that is also just as important, but not as maybe sexy, doesn't make the headlines, and maybe the return potential isn't as great, and that's a bond market. A bond is essentially an IOU. An issuing agency like the federal government or a company or a water district or the county, they need money, and so they issue these IOUs, and investors give the agency the money with the promise that at a certain time they're going to get their money back, and generally there's a coupon to sweeten the deal in the form of interest. But essentially, the IOU can be really long, like 30 years, or the term of repayment, or short, like 90 days. But essentially, it's a promise. And so with the intermediate term bond manager, about 1996, 3 bond professionals formed MetWest down in Southern California. Tad Ravel was the chief investment officer, and Stephen and Brian became portfolio managers of the intermediate term bond manager that invests in these fixed income or promises or IOUs. And the term intermediate is the length of the IOU is anywhere from 5 years to 15 years. So it's not the short durated or the long durated, it's more intermediate term. About 2 years ago, Tad Ravel, the chief investment officer or founding partner of MetWest, announced his retirement. Because he was so significant, almost like the MFS, we felt that that was not necessarily ideal, but the other 2 were still at the helm, and that was completely fine. So we placed MetWest on watch about 1.5 years ago, and the dust settled, and we figured, okay, everything is great with the 2 remaining team. Very coincidental to the previous fund that I talked about, but it's merely coincidental. Until about 3 months ago, and one of the managers of this fund announced his retirement and retired in December of 23. The other person announced his retirement at the December 2024 time period. And just given the steady flow of management changes and the lack of visibility of really where this fund is going, we have another 6 months, but our recommendation is to replace MetWest currently. The nice thing is, and maybe it's not necessarily a good thing, we are comparing in this report MetWest, a lot of those data points, with 3 very, very high quality replacement candidates. So investing in almost the same strategy, but obviously very different from a process and a personnel. The high class problem, I guess, is you could pick any one of the 3 and we'd be happy. We certainly have a recommendation and a ranking, but they're very, very, very close. In other words, we would never put a fund in this search document that we weren't 100% convicted on. Okay? So before I move into the report, I want to talk about the high yield. So these issuing agencies are almost like consumers. So let me use an example. Let's say there's a local businesswoman in her mid-40s, mid-50s, very, very successful, strong credit history, a lot of money in the bank. She goes to the bank to borrow money for a car. She's going to get the loan. Next day, a 16-year-old wants to buy a car and goes in the same bank. That person gets a loan, but what's the interest rate difference on the 16-year-old versus the well-established businesswoman? It's going to be higher. Issuing agencies are like the businesswoman and the 16-year-old driver. There's some that have strong credit ratings or credit histories, and there's some that are teetering on the brink of collapse. But they still need money, and there's still investors who are willing to pay as long as they're compensated for the risk with that higher yield, and those issuing agencies are called junk bonds. Essentially, the credit rating agencies use grades like a student, A, B, C, etc. Anything below, say, a B- or triple B is called junk or less than investment grade or speculative grade. So they still need money, but they just have to pay a higher coupon for those bond investors. And that's the difference between investment grade or the intermediate term that we're going to talk about and the high yield or junk bond manager, both of which you have on the menus in the county. All right, so let's go through. Actually, questions? Okay, let's go into the intermediate term bond manager report. So if you take a look into basically the meat of the performance report is section 3, page 5. I'll explain this first or top third. These are the 3 replacement candidates or possible replacement candidates compared to the incumbent MetWest. The peer group rankings are expressed as percentiles. So Morningstar, over these different time periods, stacks or ranks the performance of all the intermediate term bond managers in the universe. And these numbers, because they're percentiles, will always be from 1 to 100. Nothing lower, nothing higher, but the numbers closer to 1 are better than numbers closer to 100. And as I said earlier about the watch status, the expectation is they're above median. In this first half, or first third, I guess, anything below median is going to show red. And you'll notice MetWest, starting around 2021, started to suffer. In 2021, it was 64th percentile. In 22nd, it was 76. It came back closer to median in 2023 at 55th, but you can see for the first quarter or year to date, 86th percentile. So not great. But you'll see, even in the first quarter, Dodge and Cox was around median, but you can see upper decile peer group rankings over the longer term, the 3 and the 5 year are at 5 or 5th percentile, and the 10-year is also above in the upper decile. Hartford total return had a great quarter, was 20th percentile, over the 1 year 19th, a little bit lower into the 20s over the 3 and the 5 year, which is a full market cycle, and then 10-year at 22nd. And then Fidelity had a median first quarter, but the 1 year number came in at 32nd, and then almost upper decile over the 3 year and 9th percentile over the 5 year. And then you can see the calendar year peer group rankings on the right-hand side. The middle third are the absolute returns or the performance that participants would have received, meaning that these are net of fees. But I think the telling portion is the bottom third. We take the data in the middle half or the middle portion and we compare it against the index or that Bloomberg Ag. And so you can see MetWest underperformed the benchmark over the quarter, the 1 year and the 3 year, but it outperformed over the 5 and the 10 year. All these other funds outperformed the benchmark, some rather handily over different time periods. And then the calendar year, similarly up to up above, rounding out that right-hand side. And then moving into the next page, page 6. What we do in the first half of that page is take a look at return. The annualized return on the vertical axis far left, that's over 5 years. And then we also plot the amount of volatility or wiggle or risk as represented by standard deviation across the horizontal axis. And so if we're really trying to maximize return and minimize risk, we're trying to get in the upper left corner, but since that's almost impossible, the idea is get to as close to that as we can. And you can see Dodge and Cox is maximizing return, but actually taking on less risk than the other 3 comparables. As we move down into less return and actually incrementally more risk, we have the Fidelity Total Bond or the orange box. And then we decrease the return and increase ever so slightly the risk, and that's the green box or the Hartford Total Return. And then down towards the bottom is that triangle, which is the incumbent. And so again, from this, at least from this chart, it shows that Dodge and Cox shows well. And then as we move down into the bottom left, this is the 5-year Sharpe ratio. And the Sharpe ratio is essentially the risk-adjusted or risk-free return divided by standard deviation. Translated, a lower number is not good, a higher number is better. And so you can see, given the sell-off in the bond market that we saw over the recent period, none of these are positive, but nonetheless, Dodge and Cox is the highest at negative 0.01. You have that followed by Fidelity at negative 0.06. And then close to that is Hartford Total Return at negative 0.11. But you'll see MetWest has a lot higher of risk potential at negative 0.21. And then we take a look into the bottom right. We look at in strong bond markets how the funds have participated, and then how little they participated when there's a bond market sell-off. And you can see towards the middle of that chart, Hartford has done very, very well. In strong up markets, you can see that fund has participated at 112%, followed very closely by both Fidelity Total Bond at 1.11 and the incumbent at 1.11. And then last is the more conservative Dodge and Cox at 109%. But take a look at the downside capture. The incumbent did very, very well on the upside, but scores horribly on the downside. It participated at 109% in those weak markets, followed by 101 for Hartford, 96 for Fidelity, and 89 with Dodge and Cox. And then finally, from a investment thesis standpoint, we do take a look at the credit quality and the duration. I talked about the quality being high quality, like that businesswoman in my example, all very, very close. But we also take a look at the duration, anywhere from 5 to 15 years. You can see there is a nice grouping, but your incumbent does take a little bit more duration risk or interest rate risk, not much, but it is somewhat of an outlier, followed closely by that green triangle at Hartford Total Return. And there is that grouping of Dodge and Cox, Fidelity, as well as the average. I don't know if you can see the Dodge and Cox, it's that navy blue square right behind the dot that represents the average bond fund. And then the next section talks about fees. So if you take a look at page 8, towards the middle of the page on the upper half, you can see that percent EXP. The incumbent charges 37 basis points or 0.37% annually to the participants to invest in the plan. Fidelity is the least expensive at 30, followed by Hartford Total Return at 32 basis points, and then still lower than the incumbent, but the higher side at 33 is the Dodge and Cox. I have about 117 more pages, but this is typically where the discussion coalesces into some of that ranking that I talked about, even though all three of these are very, very good. Some are better than others, so I'll turn it over to the committee to see if there's one that you'd like, or if you want me to go deeper in the pages.
This is Fonse. I'd rather you give us a recommendation. We'll go from there.
Fair? Okay, our first choice is Dodge and Cox. Dodge and Cox has historically been a very, very good DC-friendly manager. They've been managing money for about 90 years, both on the stock side as well as the bond side. Very, very well-disciplined, and so that would be our number one recommendation.
On the page 5 top peer group rankings, they consistently show top performance across, so I see what you mean.
That 2021 disconnect with interest rates, yeah, they were about median, but other than that, show very, very well.
But even in 2021, nobody did well that year.
Exactly, yeah.
Yeah, I had them rank 1 also, and then Hartford 2. What was yours 2?
In terms of, Hartford would be number 2, Fidelity Total Bond.
Okay.
Yeah.
Thank you.
Okay, so do we have a motion from the board to make a replacement?
This is a Fonse. I'll make a motion to make a replacement with Dodge and Cox.
Second. We have a motion and a second. All in favor, say aye. Aye.
Aye.
Aye.
No? Motion carries.
So now moving into the high yield bond manager. This one, there are 4 replacement candidates. TIA is the incumbent American Beacon, American Funds, BlackRock, and PGIM, which is Prudential Global Investment Manager. But PGIM rounds out the 4 replacement candidates for replacement for TIA-CREF high yield. If you flip into this report on page 5, a little less compelling to change. There aren't significant structural weaknesses. It was more our investment committee was discussing not only here at the county the replacement, but we were looking at other high yield managers that might be more appropriate. And so that's why we're recommending termination. You can see on page 5, the first line in the peer group rankings, over 10 years, 32nd, 54th, which isn't staggering, but still below median, over 3 years, 30th. Back to my point, nothing earth-shattering or compelling us to pound the table and say replace it. It's just more of the mediocre performance that we think is going to continue, and there are more appropriate investment options underneath. You can see American Beacon, upper decile over the 3 and the 5 year, certainly over the 10-year at 4th percentile, which is pretty strong. American Funds, 10th percentile and 9th over the 3 and 5 year respectively, and 12th over the 10-year. And then BlackRock, about 24th percentile, following by the 17th over the 5 year and 10th over the 10-year. And then PGIM, 53rd over the 3 year, but a nice rebound as we move into the 5 year at 28, and certainly upper decile at 9th percentile over the 10 years. And then on the bottom third, you can see TIACREF underperformed the benchmark over the 5 and the 10 year, not by much, less than 1%, but 63 basis points annualized over the 5 year and 45 basis points annualized over 10 year. And that's the only option that has underperformed over a full market cycle. You can see outperformance over the 5 year, anywhere ranging from flat to positive at PGIM to 1.5% with American Beacon. Moving into a chart that should hopefully look familiar, that risk return scatter plot, a little bit different because high yield bonds perform a little bit differently than their investment grade siblings. But you can see on the efficient frontier, at least close to the upper left, is that green square. That's the American Funds high yield. Probably followed closely is that blue square. That's the American Beacon. But you can also see that orange square that's almost an overlay on the green. That's the BlackRock high yield. And then PGIM is very, very close to the average. And then similarly to the previous chart of the last search document, the incumbent is a little bit down, taking on a little bit more risk than some of the siblings, but certainly not getting paid for it. And this is what a typical Sharpe ratio chart looks like. All the numbers are positive. You can see American Beacon at 37, followed very closely with American Funds at 36. And then 31 is the BlackRock, 26 is PGIM, and then 19 is the TIACREF, that's the incumbent. And then the upside downside capture, American Beacon at 109%, followed by BlackRock at 103, PGIM at 102, 98 is the incumbent, and then American Funds at 99. But the problem is, you can see the downside capture, 104 with the incumbent, followed by PGIM at 102, 99 with BlackRock, the orange, and then the blue, 95, followed by 89 with American Funds. And then very, very, very tight grouping on the bottom portion of page 7, almost an overlay of all the funds. So they're essentially investing in the very, very similar strategy, at least from a quality as well as duration. So nothing really worthy of note other than they're all almost on top of each other. And then from a fee standpoint, the next section, page 8, you can see the incumbent TIACREF charges participants 36 basis points a year, or 0.36%, about 1/3%. Certainly if you went with American Beacon, over double the fee at 74 basis points. American Funds, there would be a reduction at 32 basis points. And then BlackRock is at 48 and PGIM is at 38. So depending on the fund you choose, there could be a significant decrease or a significant increase in the fees. I'll pause, see if questions or comments.
I just have a question, and you may not know it, but do you know why the American Beacon's expenses ratio is so much higher than the other ones?
The team is a lot deeper and the asset size is a lot smaller. And so the fixed assets are spread over a smaller pool. And so as that fund builds, we would hope or like to see the fee go down, but right now it's relatively high.
Do we know how many, how much of our funds are is in this space?
Yeah.
It seemed like it would be a small portion.
As of March 31st, in the TIA, $3.5 million.
Out of roughly 550 million, right?
Correct.
Okay.
Yeah. So 0.65% of the assets. MetWest, just curious, $12 million or 2% of the assets.
Yeah. So it seems like, again, you're saying that there's really not much of a difference between the different funds, and you're really not recommending any changes. But if I'm looking at, if all things are being equal, I'd look at the fees right now and just maybe take the one with the lowest fees. That would be my thought right now.
Is that a motion, Ponce?
I just want to put it out for discussion, just in case someone else maybe have another comment.
Well, Beacon, looking throughout, I was gonna say he was gonna, or I was guessing he was gonna recommend Beacon throughout with the performance, and then it gets the last page with the fees, so I don't know if that offsets it. And so that, I think, would be the biggest discussion is the best performer worth a higher double fees?
So internally, when we talk about the funds or the ranking, I don't want to characterize it as a coin flip, only that that's what we do, but only that it's very, very close. Really, the nod goes to American Funds, even though it's a very, very close, tied for number one with American Beacon. All things being equal, the strategy of American Funds is a little bit more conservative, a little bit more true to a intermediate term bond manager, and then the nod with the fee, certainly cost matters. And so that's where that coin flip analogy would come into play, where both are very, very good funds, but there is going to be a ranking or a recommendation, and so it'd be American Funds.
Would the committee like to provide a motion? Or any other questions?
I don't have any other questions. Also, I don't want to hog up all the emotions, so I'm trying to give my colleagues here a chance to make one.
Mr. Hopkins, can we have you just flip that button so we get it in the recording? I need to be able to hear you, please. Thank you.
I want to be heard.
This is Fonse. I'll make a motion to accept the recommendation of American Funds High. Sorry about that. The American Funds High Inc. Trust.
I'd second that.
We have a motion and a second. All in favor, say aye. Aye.
Aye.
Aye.
Opposed? No. Motion carries 5-0.
Okay, one more. This one, and the urgency is ratcheting down, which is good. This was one thing that we've been talking about internally for a while, that there is somewhat of a void on the investment menu. It's not glaring, it's not urgent, but essentially the search document has to do with an international index fund. And again, going back to my point, should I spend 30 or 45 seconds talking about what an index fund is? So we have the foundational knowledge. Okay. I want to talk about the opposite, if there is an opposite. It's called actively managed, because I think that's what most people think about investing. And an actively managed fund, and on the international side, you have two. You have international growth and international value, but no index fund. But I digress. An actively managed fund has a portfolio manager or management team, and they're scouring the investment landscape to try and buy good investments that are going to outperform a benchmark. And so they may interview Nike or Federal Express or JP Morgan, and they'll look at their balance sheet and see if it's a good company, or more importantly, if it's a good investment, because the goal is to try and beat that benchmark. And so consistently actively managed funds are learning about funds to invest in and funds to, or securities to sell to try and beat that index. About 40 years ago, somebody said, that's a fool's game. Why not just invest in the same companies that make up the index? You'll never beat the benchmark, but you'll never lose, and you'll always get market exposure at a very, very low cost. Everyone thought he was insane at the time, but he was proven right to a certain extent. Index investing doesn't have deep research or due diligence process. They're not interviewing management teams or competitors. If they buy a security, it's only because that security is in the underlying index. So back to my point about Nike. If Nike is in the S&P 500, an index fund is going to buy Nike, not because it thinks it's a great investment. They're merely trying to track the index, and by doing so, they're going to meet the performance by buying the same securities. Index funds are very, very inexpensive. Back when we transitioned the plan from the old record keeper to this one, there was no international index fund. And so it's something that we were talking about, and we're doing this only because of the two fund changes that we just discussed. There's no compelling reason other than the fact that there is somewhat of a hole for those participants who like to invest at a very, very low cost, but it's missing on the international side. So you have index funds on the fixed income or bond. You have it in the domestic stock market, just not in the international. And not to put Brenda on the spot, but she is used to this by now. Have you heard anything from participants to say, gosh, we were in index funds up and down the cap or the other classes except for international?
Yeah, I haven't had the average person bring it up at all.
There you go.
Yeah.
So not compelling, other than there's somewhat of a hole that may not need to be filled. We presented this search document to see if you wanted to add an international index fund. And so in this report, it's very simple because generally index funds are very simple. It's the performance, it's the fee structure, but equally important, what's the underlying index the fund is designed to track. And so you'll notice the blue and the grayed out rows. The funds in the blued out rows are developed markets only. The grayed out rows are developed and emerging markets combined. And I think it's somewhat of an antiquated view of the globe, but Miskey takes a look at those 45 countries and puts them into developed, like Western Europe, Japan, and developing or emerging markets like Russia, China, Africa. Those sorts of countries or continents or markets in more of the third world or developing or emerging. And you can see there's some funds that invest in just the developed and some funds that invest in the developed and developing. Any thoughts on adding an international index fund at this time?
Well, I actually had my funds in some international stuff again earlier in my career. I think if you were to select what your risk tolerance is, I think they would have thrown the international funds into it, and I was kind of disappointed it got removed. So I'd like to see it as an option. That's just personally, though.
I have some funds in international, and so I'm always looking at that, and I've been disappointed by options before. So I think I'd be interested in more. If you look at Fidelity, for example, the top one international index, 7.49 over 5 years, low fees compared to some of the other ones below.
I also like the idea of instead of just investing in the U.S. Market, you say, hey, maybe I want to get out of the U.S. market and diversify a little bit more. So. that being said, I think, Vincent, do you have a recommendation?
Yeah, despite the fact that, like you had mentioned, the top one at 3.5 basis points, 7.5% return. But those two are very, very close, and I bring up the analogy of the coin flip. I would say the nod would go down to the grayed out Fidelity, but the blue Fidelity International Index, a very, very solid choice as well.
I also like the emerging market portion, so I think he'll get a vote from me for the Fidelity Total International.
Is there an issue with adopting two?
The only issue, so short answer is no. The nationwide record keeping platform can record keep as many funds as you want. I think the participant interface, and Brenda, I'll maybe lean on you too, maybe create some confusion. Studies have shown the more choices, the less likely we're to act. So that's the only risk, but I think it's probably slight. If you wanted to add two, you could, but I don't know, any comments on the ability or the desire to add two?
It could cause a little bit of confusion, and I think that when I see people sort of leaning toward the index stuff, they're looking for the lowest fee possible. They're not really looking at like what's in it. They are looking a little bit at return, but the whole point of the index fee is the low cost for those people that do look at it.
And then, so for expenses, that would be paid by the fund participants, correct? But then there would also be some more work on both of your ends in terms of keeping track of these then, right? So it would be an additional, at least additional time, resource, and investment for you to keep track of additional funds, correct?
Yes, but I guess, yes. Yeah, but that's our job.
Yeah, ditto.
Yeah.
Just looking at the two, again, one is basically purely development, and the other one is development and emerging. Would you say that the emerging market side is a little more riskier, therefore there's a little more return? I know it doesn't really reflect that here in the returns here over the last 5 years, but overall in general, would you agree with that or not?
Absolutely, yes.
So again, if someone's taking this international side, they're probably not looking at their risk tolerance is probably a little higher than everybody else. So they're probably wanting to go for the home run early in their career, and then again they'll pull off a little bit later. So that, again, that was my argument for the Fidelity Total there. But I'm also open to whatever you like, Johnson.
I'm sorry, just real quick, this goes back 5 years. Did you know, like, the 10-year rate of return on that? I mean, because I understand what Fonz is saying as far as it theoretically has a higher rate of return because there's more risk, but it's not showing up in the 5-year thing. So, like, if it goes back farther, is that showing up? I guess my inclination on that, because I get both of it, is I would be more in line with having both of them. Sort of someone that wants to invest in the international market, but only wants the, developed countries, and then also for people who don't. But if we're just going to pick one based on the information there, even though it doesn't have the international markets, it's got a higher rate of return and a lower fee cost. And based on what we were told is most of the people that are investing in from the county, and those are looking at just the fee cost. So to me, that would make sense if you're only going to pick one, to pick the one that would probably be most popular with the participants. But personally, I'd be in favor of having both of them.
If I could say a few comments. When we are speaking with participants, we typically want the majority of the conversation to be about long-term investment strategy and less about individual fund differences, comparisons, this fund over that fund over this fund. We want to talk about broad-based, good asset allocation, diversification, long-term balancing, things like that. So again, I think to echo something that Vincent said before, Studies have shown the more options you add, the fewer decisions people make. They get intimidated and they step back rather than engaging. So I would say best practice from what we've seen from other cities, counties, administrations would be to have a single index option per fund category.
I'm open to more of a discussion, but if there's no more, I'd like to make a motion to move with one fund, Fidelity International, due to the higher quarter year, 3-year, 5-year, and lower expenses.
This is Fonse, I'll second it.
All right, we have a motion and a second. All in favor, say aye.
Aye.
And
Aye.
opposed? No? Motion carries 5-0.
Thank you.
All right, so next on the agenda is to review and approve updated investment policy statement.
Keep going. All right. Final agenda item. I talked earlier about the investment policy statement. There is nothing in trust law or even ERISA that says we have to have an investment policy statement. But in the conferences that I attend, when we talk to outside legal counsel, they say one of the first questions that the Department of Labor or the IRS or suing law firm ask is, do you have an investment policy statement? Do you follow it? And when was it last updated? So keenly aware of all of that, representing best practice. We do have an investment policy statement for the plans of the county. And all it is a roadmap or a guidebook, if you will, that sets out parameters. They're not too tight and they're not too loose, but rather it allows you to exercise some discretion, but gives you some guardrails in the selection, the monitoring, the watch, the termination of the funds on the menu. And so once a year, we go through it and make sure that it's still up to date. And if not, we make some changes. And so if you take a look, obviously on the cover, we're proposing a change in the time period, as well as on page 2, the table of contents. But on page 6 is where the changes are really more in the form of more discussion. So on top of page 6, you'll notice that true to form, as these vintages get closer, or the year 2030 gets closer, the amount of equity gets smaller. And so Morningstar says the range used to be 50 to 70%, now it's 50 to 65. We're updating that on the top part of the 2025 and 2030 portion. Similarly, what used to be a 70% low-end range is now 65, and so we're making that change in the next box. And then in a previous meeting, the committee voted to add a money market fund, and so that asset category is now going to be codified within your investment policy statement. And really, that's it until you get to the end, where on page 12, we just add this to the history and say, not only is it contemporary, but we're following it on a regular basis.
Vincent, quick question. What if we strike that whole sentence, with that range?
Why don't you? Because again, I think it goes back to the guardrails that there should be some expectation of the equity exposure in the target date funds. But I go back to, this is your document, and so if you say, yeah, I think it's better to strike it, we would strike it.
Yeah, I think you still got that guardrail, the next sentence, which says, hey, anything, not to exceed 50%, so that figure is still there. It seems, wouldn't say burdensome, but it seems like, again, it would be difficult, not difficult, but I guess you could come back every single quarter and make an adjustment if those parameters were changed. And then,
Yeah, that's a good point.
And then the last comment would be, do we need that history section? Imagine 100 years from now, this would be 4 pages of it. So I think maybe we should just say the last time it was updated instead of listing out the history of when these changes were made.
Another good point.
Those are my comments.
I'm assuming the history statement is really more for like a legal standpoint, so you can show how often and easily, you've actually taken a look at your plan, your strategy and updated it, or no?
Yeah, it doesn't hurt, but I think this is probably the only investment policy statement with the history section. The others are just merely on the cover. It's contemporary, it's updated, 2024, regardless. But yeah, I think it's more kind of the belt and suspenders of the cover as well as the history. But you're right, you could conceivably see it in 5 years, 6 years, 7 years.
So I have a question, and Aaron, this may be for you. So in addition to the question about the history, it did raise a question, though, looking at it, that it was originally adopted by the board. So I would assume that part of that adoption indicated that future amendments were delegated to this committee and didn't have to go back to the board. I'm just wondering in a way why the policy was adopted by the board at all, or?
I would have to look at that board order to see
Okay.
what type of delegated authority was given to the committee, or perhaps to you even as the plan administrator, because the committee is advisory, so it may be to the extent that they're saying we adopt or we accept these revisions, that ultimately as the plan administrator, you may have the delegated authority to then
Okay.
effectuate the changes in the document, but I'll look at that board order. But you're right, in terms of past practice, it hasn't gone back to the board.
Okay.
Again, I made those comments regarding the history of the work on several other committees, and you'll see that in the bylaws. And then again, it'll show how many changes. One of the things I've also done is in our office policy is just maybe put a note under each section is when this section was updated.
Yeah.
Maybe that might be easier.
I do know that, for another board that we're on, Fonse, that the history has been helpful at times, but it also included what was changed. And so it was kind of like a quick, easy place to look. I know we had some litigation where actually the history of the bylaws changes have been helpful, but this in itself is not terribly helpful. It just says when it changed. It doesn't say what changed. So.
But again, if we're looking at it, I'm pretty sure we could pull up the 2022 investment policy. We could pull up in a year, and we should have it. I'm hoping we have it
Yes.
somewhere. Exactly.
I know HR keeps track on, if you look at a job announcement on the county, it says this position last reviewed, updated, whatever. And so that way you get at least somebody put eyes on it and made some change and it's been reviewed. Some of them are, originally created 1965, it says. So.
Yes. Right. Any other thoughts or questions from the committee?
I just, going back to the wording on the percentage range, I actually think it's better to keep it like the way it is, because the other sentence refers to international equities not exceeding 50%. The range of, say, 50 to 65 includes international and U.S. stock, so it's not the same thing, so.
Was that sentence copied from somewhere, from the parameters or somewhere, or is that something, one of our recommendations?
Which sentence?
The sentence in regards to the stocks generally were comprised of 65 to 95% of the total portfolio.
I would say it was copied from our template or our boilerplate starting policy.
So you said something like stocks are generally comprised of greater than 50% of the total portfolio. Actually, do you even need to make a change? Because you're saying, hey, it's within this range, and if it's under, hey, we're saying it's generally it's in that area. So again, if you say 65 and we're at 50, we're kind of in the ballpark as long as we're not at 1, right?
Correct. Yeah, because 70 does encapsulate the proposed 65. You need to know. That's just how Morningstar categorizes the equity portion of 2025 and 2030. So you're right, we not necessarily.
I'm sorry, just to make sure I understand. The reason it's changing or potentially changing is because these are the target fund dates, and as it gets closer, you want to get less and less risk, so your stock investments, whether they be international or U.S., go down in that target date range because you're modifying the risk of that target date. So you would want, for me, as you're talking about specific target date funds, you would want to see a change in that range, otherwise there's not any point of having the target date funds if they're all gonna be the same. So, I mean, it makes sense to me that eventually you would look at that and each year, not each year, but that sometimes you'd say, okay, these target date funds, we're gonna change our asset allocations to reduce the amount of stocks, whether they be international or domestic.
Right.
To modify that risk as people get closer. So
Yes.
I personally kind of like it, but that's just me.
I've got a question, kind of maybe on the practical side, so maybe more for nationwide. So our policy says what we want our funds to look at, and then are you looking to make sure that the funds that we have available, the target funds, are aligned with that? So
Yes.
is that really, if we don't change the policy to indicate the more conservative, are potentially, can we end up with funds that have more risk embedded than we would like to see for the different target dates? I don't know if I'm making sense.
No, you are. And this is exactly why, and I go back to performance report number one, where you would see on page 26 are the target date funds. And so if there was ever a violation or independent of 65 or 70, if our analysts looked at the asset allocation of the target date funds and they thought that they were too risky or not risky enough, they would show red. Maybe not all of them, but we would look and screen them against really what best practice or others target date providers are doing. And if there was an issue, we would call it out on this page.
Okay.
Yeah.
And so when you look at T. Rowe Price, is obviously all of these ones listed here, are these generally going to be mirrored in every other deferred comp plan that these ranges, or you see it mirrored everywhere else? Or would we say, you know, we need to replace this fund because they're become more risky than we would want?
The first question is, are they mirrored in other deferred comp plans? Probably not. They're 35 to 45, depending on the time period of target date providers.
Okay.
And so some plans could use different target date funds. But what we would do is make sure that the asset allocation is appropriate for a deferred comp plan, and if not, call it to your attention. And the other thing that we did with another is almost like a search document for the bond fund, but for target date, not to move away, but just have that conversation around the allocation. And there is a tight band, so there wasn't an outlier, if you will, but it was just good conversation to see, take a look at the glide path, take a look at the fees, take a look at the performance. And so that's something that we could do. But yes, our analysts and our regular communication with the team at T. Rowe Price, we're constantly saying, how do you build these? Are they too risky? Are they not risky enough? And if there is an outlier, we would either show this red and call it out to you, or call it out to you independent of this.
Okay,
Yeah.
thank you. Any other questions from the committee? Do we have a motion?
I just wanted to point out, sorry, real quickly, there's just one cleanup item, so not anything substantive, but on page 2, under section 2, that last paragraph still has the last update is June 2020, and I think it just needs to be updated to the May 2023 date.
Good catch. Page 2.
Yeah, section 2, that last paragraph.
Oh, yeah.
June 2020. And I was going to say, in terms of advice to the committee, potentially, I mean, we could look into, in lieu of, I think in the April 2023 meeting, this issue came up as well in terms of the history and tracking it, and just the it being a living document that will become voluminous. We could probably look into a best practice and explore what other committees are doing or departments, and then maybe come back at another time if it's another amendment or revision that we propose to possibly track the history differently. And then that would, in conjunction, have another revision to this policy statement, rather than trying to make a decision today. I don't know if that's.
Thank you.
This is Fonse. I think the word general in there is good enough. I'll go ahead and, in the interest of time, make a motion to accept the changes as proposed.
I'll second.
All right, we have a motion and a second. All in favor, say aye.
Aye.
Opposed? No. Motion carries 5-0. Thank you, Monse. All right, next on our agenda is committee member comments. So does any committee member have a comment they'd like to make?
Might be a little immaterial, but is it possible when we get the package via email, we kind of label it, say, hey, this is attachment A, B, and C, so it's easier to kind of follow? I know that we had some issues here, but I typically put notes on my agenda and just kind of go through it, but it'd be nice if it'd be in order. That's all. It's minor comments.
Okay, so when we're distributing the documents, you would like to have it clearly marked which item on the agenda these.
Correct, like it'd be A, B, C, or 1, 2, 3, whatever you have down there.
Absolutely. Thank
Be
you.
nice.
We can look into doing that on our end, if it's our highest, because it seems like we have a lot more, or nationwide too, but if it's just us, we can work on it, as opposed to you, if that's okay.
Absolutely, thank you.
Receiving the email earlier would be great too, please. Just more time to review, because I like to mark it up. I have my binder, I print everything out, but I mark it all up for funds and recommendations and thoughts.
I think I said it in a prior meeting, I don't need a hard copy, so I'll
Okay.
just go ahead and accept the soft copy.
I want to say also thank you to our experts. I appreciate all of you, county council coming in, finding different things to look over. So I really appreciate the expertise and the advice and recommendations.
Then the only comment I wanted to make, actually, a couple things. One was that the plan, the county did receive a pension and investment award. And so, and it mirrors the award for the same project for the virtual courtyard from Nationwide. So thank you for the submission and for the work on the project. We are looking to find a time, and I'm thinking it may align with like the National Retirement Planning Week, maybe having a presentation of the board sharing both of those, both the NAGDA and the pension investment awards with the board, and talking a little bit, maybe we can use that as an opportunity to talk a little bit about some of the communication and targets we'd like to get to our employees. So we will certainly be sharing that, and if anybody would like to be present for that at that board meeting, we would welcome your participation in that. If there's nothing else on the agenda, we will close the meeting. Thank you.